will go to dollars, and people will say, my, something's wrong. The U.S. dollar keeps going up and up and up, but gold is going up and up and up also, because people are taught that the dollar and gold move opposite. Not at the end of the game, they don't. People are seeking the most liquid, most trustable, most tangible asset they can get, and that's both dollars and gold. And then what I think will take place is, as you suggested in your question, is people will start to say, wait a minute, are these dollars really worth much? Compared to gold, they're not. Gold keeps outperforming dollars. Every week I check the gold price. It takes more of these dollars to buy an ounce of gold. So what will happen then is people that are liquid will start moving that dollar into gold, and then you'll see a bifurcation between the dollar and gold. Gold will keep going higher in terms of dollars. So I think that's the most likely case. But I've talked about for years is, interbank failure, where the banks don't fail, they freeze. And that's what happened in 2008, where banks don't trust each other. We're seeing that every day because of this repo market, where banks are afraid to loan to other banks overnight. So they have to go to the Fed, who can just print money out of thin air and borrow from the Fed overnight because they don't trust each other's balance sheets. Something, to me, very scary that we really don't know. I won't even speculate because I can't even think of what it might be other than trust, but that's a big word. I mean, we could be in a situation because of this virus thing. As an example, I don't know, where the government says, you know what? No more cash. Cash bad. Cash carries virus. Can't touch cash. We're going to the Fed note. The Fed note's on your phone. Your bank account has been, changed to a blockchain currency called the Fed note. And the Fed note will be accessible by your phone. Your bank will be contacting you shortly with your PIN number. Once your PIN number is entered one time, write it down, because you will have to come up with your own new PIN number to access your funds from now on. No more cash. Thank you very much. Have a nice day.
Welcome back to Liberty and Finance and Reluctant Preppers. We have a popular returning guest who is a guru in the silver space, known as a silver guru. David Morgan is here with us this Wednesday, March 4th, 2020. David, thank you for joining us again here on Liberty and Finance.
Well, Doug, I always have fun with you on your show. And, Chris, as I've said in the past, I don't take the guru moniker very seriously, but nonetheless, I have devoted a lot of my time and energy to the silver market and the markets in general, and honest money and a lot of things, monetary history primarily. But the guru, I did that kind of as a joke, so I won't go into it. I've said it on your program many times, but you can refer to me however you wish. And like everybody on the planet, I've got my fans, my detractors, and there's people that, could care less. So let's carry on.
Well, I will say that actions speak louder than words, and our viewers, when invited each time before your appearance here to submit questions, flood our inbox with questions as comments below the video. So thank you all for submitting your questions for David Morgan. We'll try to get several of them ahead of into this comment stream right now, and I'll jump into the first one. Eric C. from Germany says, my question for David, will there be a world peak silver like there was an oil, peak oil? Has it been reached? Will it be reached in the next 30 years?
Well, that's a very tough one. I mean, my predecessor, Jerome Smith, predicted like $200 silver in the middle of the 90s, and he was a very bright guy. And so I went, and his books are not very academic. They're pretty much written for the layman. He wrote all kinds of books on silver. So anyway, I went and I read the book for the third time, and I found his fatal flaw. And what he did was he did a linear assumption on the mining activity of the world, which at the time seemed like a valid assumption. And he left out what happened, which was a technological change that took place in the mining industry that changed that curve drastically from mining like 380 million ounces of silver on an annual basis for like 100 years. That was the ceiling, to a new paradigm because of the technology change. So for me to sit here and say, hey, I don't, to say I know or this is what's going to happen, I'd be making the same flaw. So now that I've made that that foundation, let me say, if there are no technological changes, then we have to look at the economics. So if silver is at 500 an ounce, deposits now that are absolutely worthless and referred to as moose pasture will become economic and they'll be mined. So that's point number one. Point number two is I'm pretty convinced we're at peak gold, meaning that the mining industry is mining 1 gram per ton gold. And that's just unbelievable. That's $40 worth of gold in a ton of rock or dirt. That's extremely hard to make a profit on that low of a grade. And they're doing it because they can't find higher grade. Silver's grade has gone down substantially if you read any of SRS Rocco stuff, some of mine. But nonetheless, there are about 3 very large, robust silver deposits on the planet that I'm aware of, and 2 of them are addressed in the Morgan Report as speculative investments. So I don't really think, even though the silver mine supply has decreased the last 3 years in a row, yes, people are definitely aware of that, doesn't necessarily mean that will continue over the next 10. Having said all of that, if there isn't any big technology change and the price of silver isn't all that high, I think because of the increased demand for silver, on an industrial basis, we could see peak silver. So if I was just going to guess, and I'm just going to say guess, I would say it's probably 10 years out. The reason I say that is these deposits that I know of are like billion-ounce deposits. Billion ounces is like the oil market. But then you stop and really think about it. We need about 1 billion ounces a year just to have supply and demand balance in the silver market. So if I'm talking 3 billion ounces here, roughly, maybe it's 4. We're really only adding 4 or 5 years onto the current level of silver supply that we already have. And those mines have to be permitted, developed, and mined. So that's my answer. I think, yes, we will get there. But, honestly, before we get there, I think this financial system is going to have a reset of some type. So that all of that may be a moot point. So that was a long answer. I hope it was beneficial to everybody listening.
That's all right, because you did touch on the industrial demand side of silver, and that plays into the next one I wanted to ask you. Nano Russian Bot asks, other than reversion to the mean arguments, why, in the next few years, would the gold-silver ratio reduce? Gold is regarded more as a monetary metal, and silver is regarded more as a commodity. Given the intractable government obligations situation and the slowing of industry due to the coronavirus and other pre-existing factors, why wouldn't gold soar and silver just keep pace or maybe even fail to?
Yeah, great question, and you don't have to buy my argument, but let me argue the positive side of silver. Silver trades, as you say, as an industrial commodity, and sometimes it trades like a monetary metal. Right now, it's been trading like an industrial commodity for quite some time. Now, if industry closes, you're going to lose 70% of the silver supply because 70% of the silver supply comes from lead, zinc, and copper mining. So now you don't have as big a silver supply whatsoever. So that cuts back the mining significantly. And secondly, silver is a monetary metal. It's actually been a money more often, more places, more transactions than gold ever has. So I think under the conditions that you're outlining, we would see a run to gold, and gold would be priced out of most people's ability to buy it. And there'd be a spillover effect into the silver market where people realize silver is not gold, but it has every property of gold. It has every property of classic money. And the word silver and the word money is identical in the Romance languages. Argentina means little silver. Plata. When you go in Mexico and say you want some plata, you say, I want some silver. They regard that as money. It's like in the United States, you say, grease my hands with silver or whatever. Well, we know, if you have any awareness, that you're getting slugs from the U.S. Mint, but we refer to them as silver. So the idea of silver just being an industrial metal, I think, is false. Can it trade just as an industrial metal? Yes. But it trades as money, especially under the conditions you're outlining. So I would argue that you'll see gold go, and at that time, since the silver supply the total amount of money available to run into something of value, an asset that's a hard asset like silver, gold, platinum, palladium, is so small relative to the amount of dollars that have been printed. I think you'd see the ratio go to an extreme. It's at an extreme now. And by the way, while I'm on the topic, I was asked today on a TV program I was on, what does the 100-to-1 ratio mean with the gold-silver ratio at that high a level? And it actually means there's a financial crisis. And that doesn't mean it's going to happen this time. History doesn't repeat exactly. But every time we've seen the gold-silver ratio get to that extreme, there has been a financial crisis. So we're basically at that extreme, and it's on a spike. It isn't like it gets to 100-to-1, it stays there for 12 years. It gets there, it stays there for a small amount of time, and then it starts to come back down in silver's favor. So I still, and obviously I'm biased. I mean, I am very biased. I've studied the silver market my whole life. I continue to study it. But I also want to think through all the arguments. I want to find any flaws in my own thinking. And, as I said, it took me a while to find Jerome Smith's flaws. The guy's pretty darn bright. But he made a bad assumption. And, as Ayn Rand would say, check your premises. And I do, and I recheck them. So, if there's some fatal flaw in my thinking, you can let me know. But, I have thought it through diligently, and I don't see why people would say, oh, I'm not buying silver. It's a hard asset. It's preserved my wealth for thousands of years. And that's my last point. If you're going to look at long-term investment, what are you going to put on that you can have, that you could pass on 5 generations from now? Think about that question. If you're going to give something to your grandchildren's grandchildren, how would you do that? And the answer is there's really only 3. There's land, not real estate, because in 5 generations, they might take that property might be condemned or blown down, or, the ocean might suck it down, or who knows. But land, precious metals, and fine art. That's about it. If you're going to go for multi-generations of legacy wealth, you could buy all the Google stock you want. But to think that thing's going to be worth what it is today, 5 generations down the road, it could be, but it's highly doubtful. The only stock in the Dow Jones Industrial Average that lasted more than 100 years was Homestake Mining. That's the only one. So anyway, I know I'm on a rant today, but you let me speak. I love you for it. Next question.
As long as you include in the category of fine art, fine whiskeys or fine wine, I'm on board with you there. So,
okay.
We have a question from CEB that echoes some of the themes you just introduced. Charles Bruce from Arkansas asks, we've just been through a market correction, and physical precious metals and mining stocks took a good hit along with the market. When can we expect a bottom in order to buy more metal and mining stocks?
Wish I had an absolute answer. I'll give you my feeling on it. And I like to be a thinker, not a feeler. But in the 2008 crisis, the same thing happened. Everything got hit, and hit very hard, including gold. Gold was hit the least hard, meaning it went down, if I recall correctly, about 30%. But it was the first to recover, and shortly thereafter, silver came up. Silver went from a $9 bottom up to a $50 top. It went up 6 times. So I think we're facing that kind of situation. You probably wrote this question just a few days ago, and we've also already seen a recovery in gold of about $50. Mm-hmm. So these are very tough markets to navigate. You don't want to be on margin. You don't want leverage. You want the best of the best. And remember, the function of a bull market is to shake off as many bulls as possible, or shake off as many people off of the bull's back as possible. So there are probably people that when we got the $60 decline in gold that stayed there all day, got people just absolutely, just burn them out. Maybe never to return to the gold market, unfortunately. But be prepared. There's more ahead. This is the function of a bull market. Climbing that wall of worry. Oh, it shouldn't go up. It could go up. Oh, it's going up. It should go up. Yes. And then down for no reason. And, and on it goes. So the right amount, I think, is the main thing I can stress. What's the right amount? Well, that's really up to you. But 10%, 5% is usually best for most people. Most people that put in, 20, 30, 40, 50%, everything in it, they are the ones that have emotional roller coaster that most people can't handle. So, you got to know yourself, to your own self be true. And I would say it's a must investment. I think having, if you got food, you got water, you got, some first aid kit. I mean, the times we're living in really demand you think about those things. If those are all taken care of and your debt's paid off and everything else, and you have some money to invest, I'd say hard assets, probably starting with silver, and don't go overboard.
I think buried in that question may have been the latent implication of why would in addition to the broader stock market selling off, why would precious metals, mining stocks, and precious metals themselves sell off if they are considered a flight to safety, that sort of thing, in times of risk?
Yeah, it's true. I mean, basically, I'm just repeating what I said, but it isn't an instantaneous day-by-day event. When I say that gold's the most negatively correlated asset to the stock market, gold and not gold stocks, then what I'm saying is that that's a fact, and it is. It can be proven. But that doesn't mean every day that the stock market goes down, gold goes up. If there's a big sell-off, gold won't sympathize with it. And gold stocks go with gold because they're very correlated. But gold stocks go more with stock market than gold itself because they're stocks. But whenever these big, massive sell-offs occur, the fund managers almost all hold a position in gold for a hedge. And they use that hedge that they need to sell that because it's the only thing they can sell. And it's the most liquid asset in the world. And they sell it to meet a margin call or whatever. So that's probably what takes place. That's what most of the analysts will tell you anyway. And there is some truth in that.
We have a question from Aussie Bird who says, can David explain why on a sellback price to Perth Mint, so she's Australian, we lose about 14% for silver but only 5% on a sellback for gold compared to spot price? If there's a formula, does David see the 15% being maintained when we reach 3 figures per ounce, or should then the buyback losses be closer to 5%? Or maybe this is just an Aussie thing.
So the spreads are made by the market makers. And gold, again, as I just said a moment ago, is the most liquid asset. So because it's such a liquid asset and there's so much demand for it, the spread is thin, which is, as you said, 5%. Here in the States, it's usually around 3%, but it changes. The spread can go very narrow, like 2.5%, and it can go quite wide for gold, maybe like 6%. I'm talking in the U.S. So it varies. Now, if you go into platinum group metals, it's a huge spread. I mean, you can buy platinum for $1,000 an ounce, turn around, walk out the door, walk back into the coin shop and say, you know what, I don't want this one platinum coin I paid you $1,000 for. I want to sell it back to you. And the dealer says, fine. And you're thinking you're going to need $1,000. That's what you paid him. No, he makes his money on the spread between the buy and the sell. So you bought it for $1,000, but he'll buy it back, or your sell back to him is going to be like $850. So and that's not a made off the top of my head number. And on palladium, it's even wider. And on rhodium, it's humongously wide, like maybe 20%. Now, 14 is an extreme amount on silver in the United States. I don't know what the standards are in Australia. 14 may be normal. Now, the other part of your question is, will that hold at the top of the market? And the answer is, I don't know. But normally, if you sell into strength, the market's margin is very thin, which means there's a lot of people that still want it. You just got to be smart enough to sell it to them when everybody wants it before it gets to the very tippy top, because at the very tippy top, and when the buyers are exhausted and there aren't any more buying, then the spreads will widen dramatically. So you've got to be a little bit careful. You don't want to be too greedy in any market. You don't want to try to get that very tippy top because there are no real buyers at the exact top. You want to sell in the strength, leave some for the next person, be happy you made a great profit, and carry on.
I definitely have experienced that even in stock trading in days gone by, is that when there's a robust upswing, there's lots of buying going on. It's a well-traded market. There's good liquidity. You can get a very narrow spread. But yeah, makes sense. Don't hold on for the peaks. We have one from Frank Scarfoni who asks, Mr. Morgan, why are rhodium and palladium on a rapid rise, especially rhodium? Is it strictly based on supply and demand?
As far as I can tell, I wrote about it in the Morgan Report, and I know the PGMs better than many that are in this sector, but I'm no expert, although I was asked to be on the platinum panel a few years ago. But regardless, as far as I can tell, yes, it is supply and demand.
New World Forward says, do you think the monetary demand for silver will overtake industrial demand in the ensuing crisis? And at what point would you expect this to happen? Yes.
In fact, I've pretty much staked my whole life on it. all markets move at the margin. So 60% of the market in silver is for industry, and about 25% is jewelry. So there's 85%, which leaves about 15% for monetary demand. There's some other artwork, but that's basically it. So if there wasn't any monetary demand, the price would be basically what it is now, because it's going to cost what it costs to produce it out of the ground, or there isn't going to be any production. So you can't say silver's going to $5 when it costs $15 to get it out of the ground. You're going to get $15 for it, you're not going to mine it. Eventually, there'll be some mines that mine it at a loss, but not for very long. So that's point number one. And I'll just repeat it, I'll try to be succinct. Yeah, monetary demand is going to move it. It's going to move it probably after gold starts to soar. And when the currency crisis develops to where your neighbor starts telling you about monetary problems and fiat money and the problems of, interest rates going to the moon and all this other stuff, when your neighbor starts informing you and they wouldn't listen to anything you had to say, silver's going to take off then. So the monetary demand will take hold.
We have a question from Bat Soup. Are there physical gold and silver ETFs out there you think are safe?
I think that there are a few. I also think that you're better off with it in your hand, but once you have it in your hand, if you want to participate in those, I think the PSLV is pretty safe. Central Fund of Canada was bought by Sprott. I mean, they were buying it basically on the cheap. They're buying a physical asset under market price. I mean, which is a smart move on Sprott's part. So that isn't a recommendation of mine anymore because it doesn't exist anymore. And I can't really think of any other ones. There are one or two more. I'm sure there's at least one more, but it's slipping my senior moment right now. But there are a few. You got to research them. You got to read the contract very carefully. In the case of the PSLV, you can take delivery if and only if you meet certain thresholds. And most people don't have enough money in it to meet those thresholds. So don't let anyone tell you that if you buy, any of these physically backed funds that you can actually get physical for it. That's very restrictive on who can actually get the metal.
We have a question from Keith Owens, and I think this has been a subject that's been brought up recently in a number of publications by Bill Holter and Jim Sinclair, and that's about the volume of physical precious metals that the COMEX is asking the LBMA to satisfy for them. He says COMEX supposedly delivered 6,000 plus tons last year of gold. There has to be a massive shortage now. Is there any way to determine when this shortage will come to light? And that just plays into that bigger question of is there all these exchange for physicals to the tune of these massive amounts that are being shifted from the COMEX to the LBMA to supposedly deliver physical? Do you have contacts or information that there is a burgeoning demand for physical delivery recently, and how can it possibly be satisfied?
It's an excellent question. I wish I could give you an answer. Bill and I are friends. We went to Germany together and spoke and spent pretty fair amount of hours together. And he calls me now and then, and I call him now and then. I have definitely studied the exchange for physical proposition and some papers written by my peers. And honestly, I don't understand it. I'm not sure if it truly is anything more than another paper game. Mm-hmm. I lean toward it's just another paper game. It's really not something that you can really get physical for. It's an exchange for physical. It's another, piece of paper that I can exchange this for physical. But what's the fine print say? Well, you can exchange for physical in a swap contract that's made into a mine that's going to be developed 20 years from now. I mean, I'm being facetious to make the point. I don't know. If the physical demand was backlogged that far, I don't think it would have disrupted the market before now, is my logic. So I think it's just another hypothecation, a fancy word for another way to loan, swap, lend, use it as collateral type of methodology. And it's just something that continues to go on to baffle the unwashed that still think that they're buying gold when they get a piece of paper that says gold on it.
We have a question here from Sandy Phillips, who says, I've been told that pre-1965 dimes and quarters will be more desirable after the crash if there's hyperinflation because the larger denominations will be more difficult to trade or spend if you need to buy something. What are your thoughts?
Yeah, I agree if that's the case. She gave the reason why. And I'll just add on to that. There's a guy, I only got to interview him once, but I wish I would have kept better contact. But regardless, he went through the Argentinian hyperinflation at least twice, and he wrote about an 8-page paper on it. And he said he wished he had more jewelry because a lot of them would take a ring or a small chain or a bracelet or a pendant or earrings or something like that in barter. So that's back to what she said, small items. So I think I used to tell everyone to start your silver supply, your silver investing to buy try to buy a bag of, what we call junk silver, constitutional silver, for your family. That's $1,000 face value. It's 720 ounces approximately of silver. So you can do the math. 720 times whatever the price of silver is what a bag will cost you roughly. And, dimes or quarters, you really don't see $half bags anymore. I mean, there might be a few, but it'd be hard to call up a dealer and say, hey, I want a junk bag and I want it to be $half. They are very slick if you find them. They're so worn. But regardless, I agree with you. I think that's the best. I mean, if you have dimes, you got a very small unit of silver, But in other cases, the market's pretty good at being efficient. So if all you had was 1 ounce rounds or 1 ounce coins, someone would make you change, or you would have to overpay. I mean, she makes a good point, but the market would get efficient. I mean, basically what would happen is the people that had the junk silver would spend it in the marketplace, and then whoever that merchant was that had, the apple orchard that was selling apples like crazy, after a few weeks, he'd have a lot of, 10 cents pieces that he could make change with.
We have another question here about after a sell-off. Serbian Mike asks, Mr. Morgan, is it fair to say that this early in the sell-off, people are running to the security, and I'm using that term lightly, of cash? When things bottom out, the reallocation of assets will be placed into gold and silver? I ask because I've noticed this pattern in the past and wonder if there's any reason to suspect a different outcome this time due to the Fed's loose monetary policy.
Excellent question. Good thinking. I guess I was going to have a real quick, not a quick, but an answer, but I don't know. I suspect there'll be a day that happens. I've always felt and thought that the main run will be to Exter's pyramid. You can look it up. I'd show it on my screen, but I don't have it right in front of me. And it's Exter, EXTER, pyramid, and it's a liquidity pyramid. It's an upside-down pyramid. I was actually the first, I think, to bring it back into the discussion about precious metals in the monetary system. So the base of the pyramid is gold, and as Chris Duane does, he puts silver at the very tip, and I would actually do the same thing. But right above that is dollars, is physical dollars or physical notes of whatever country you're in, but particularly the U.S. dollar because, Zimbabwe went to the U.S. dollar, Argentina goes to the U.S. dollar, all these nation states, if their currencies fail, use the greenback, use the dollar as their currency. So I think that we'll go to dollars. And people will say, my, something's wrong. The U.S. dollar keeps going up and up and up, but gold is going up and up and up also because people are taught that the dollar and gold move opposite. Not at the end of the game, they don't. People are seeking the most liquid, most trustable, most tangible asset they can get. And that's both dollars and gold. And then what I think will take place is, as you suggested in your question, is people will start to say, wait a minute, are these dollars really worth much? Compared to gold, they're not. Gold keeps outperforming dollars. Every week I check the gold price. It takes more of these dollars to buy an ounce of gold. So what will happen then is people that are liquid will start moving that dollar into gold, and then you'll see a bifurcation between the dollar and gold. Gold will keep going higher in terms of dollars. So I think that's the most likely case.
There's a couple of questions that kind of mirror each other, so I'm going to give them to you both. The Pulse family asks, Are there any reasons I should buy 999 silver bullion when I can buy 925 sterling or 830 silverware for far below spot? 830 is a standard for Scandinavian silverware. Has the purity any significance? And the related question from Keith McQueen, what premium should I pay for 49 silver bars over 39 bars?
Well, 49s to 39s you shouldn't unless you have a special purpose for it. I mean, if you're using 49s for ionic silver or something in that case and you need that specific fineness, then buy it. Unless there's a specific reason to it, I wouldn't pay any premium for 49s over 39s. On the other question, depends what you want to do with it. If you just want silver, that's fine, but it's going to be the same both sides. The buy-sell market that we talked about, the bid-ask spread. When you buy it at that steep discount, yes, you're buying silver. You're buying 92.5% fine silver, but you're also buying copper. And so what happens is when you go to sell it back, you're going to sell what you have. When what you have isn't 999 fine. So you're not going to get the silver price for that sterling or that 80% or whatever. So it depends what you want. If you want it to convert into, a monetary asset, you're going to have to get it pretty much to either 90%, which is what a silver coin is in the United States. And I know that some coins like Canada had a 70% coin and all that. So you could, factor it in. But if it were me and I could buy it at a deep discount, I would exchange that for monetary silver over time, if that's your purpose. And I don't know what your purpose is, so it just depends.
Interesting question here for people desiring to reduce risk. Josh G. asks, if there is a market collapse, is it possible for the trading exchanges and brokerage houses to collapse as well from the enormous margin debt? And if so, would people lose their shares or cash held in those institutions?
It's possible. That's certainly a very extreme case, but we can't rule it out. I mean, we saw investment banks go down the tubes. We saw Lehman Brothers. We saw Bear, which had been around for, 100 years or something. So they do fail, and it could happen again. In the instances where it's taken place, the SPIC, which is the Securities Protection Agency, guarantees brokerage accounts to $500,000. Whereas your bank will only guarantee half that amount. Chances are, in almost all cases, even if they close the exchanges, they usually will reopen, like happened during 9/11, and you will be able to get your, cash equivalent, or the stocks will trade again or whatever. So I wouldn't put too much worry in the extreme case, but to be honest, yeah, it could happen. And I think the bigger problem, and I don't know, but I've talked about for years, is interbank failure, where the banks don't fail, they freeze. And that's what happened in 2008, where banks don't trust each other. We're seeing that every day because of this repo market, where banks are afraid to loan to other banks overnight. So they have to go to the Fed, who can just print money out of thin air and borrow from the Fed overnight because they don't trust each other's balance sheets. Something, to me, very scary that we really don't know. I won't even speculate because I can't even think of what it might be other than trust. But that's a big word that means a lot of things, or has a big connotation, I should say. And I don't know what it is. I don't. But it implies that there's something very, very difficult that exists in the financial system, and everybody's sort of ignoring it and pretending that things are okay by going to this overnight loan discount window at the Federal Reserve and moving forward. Remember, bailouts are now illegal. Bail-ins are the only way you could take care of the next financial crisis. So if you have money in the bank and the banks freeze, as I suggested could happen, not would happen, but could happen, you would be in a situation where the bank would take their money, even though it's your deposit. They look at it as their money. And how much would they take? And my guess, so I don't scare anybody, is they probably go for the deep pockets first. Anyone that had a deposit over the guaranteed $250,000, they would take some of that, all of it, I don't know. And the people that had less than $250 might be left alone, I'm guessing. But that's kind of from history, kind of what happened in other countries. So we are in uncharted waters. I'm not trying to scare anybody. I'm not trying to play the fear card. I'm just trying to let you know that, if if you have financial assets, and again, you have your food, your water, whatever, and you have savings, some of that savings should be in physical metal. I mean, that's the number one bottom line asset that's lasted for thousands of years, and in my belief system will continue to last for several hundred more, if not thousands more.
This last question kind of turns us back to the question we've been dancing around for some time, which is about peak silver. It's about what happens when industrial demand drops off during a recession. But this one puts an interesting twist on it, and it ties back to something you said about silver being a byproduct often of copper mining, that sort of thing. John Schmidt says, if the economy slows down due to the coronavirus and debt and a recession, this should drastically reduce demand for base metals like copper. Since the bulk of the silver supply is based on it being a byproduct of base metal production, wouldn't there be a drastic cut in the future supply of silver due to this, and won't this more than offset any demand drops in silver for its industrial uses and create a larger supply-demand imbalance for silver than currently exists?
Yes, and we'll expand. So let's take it more extreme. Let's take it to where we see this coronavirus, or whatever you want to blame it on. Let's just go use the coronavirus. That's the news feed. Takes out the mining industry. People are afraid to go to the mine. Or let's say maybe it doesn't take out the mining industry, but all the mills decide they won't process ore anymore. Everybody goes home. Well, when you work from home in a mill, not very much gets processed. So if that were the case, what would happen? Well, I would suggest that most of the mining shares wouldn't do very well. But the metal itself would probably go bananas, because now you've still got some industrial demand for silver because they're still making iPhones, even though it's delayed. I understand that. It's, you hear that every day in the news. But you'd have monetary demand like crazy. And so the metal that is left, and no more coming above ground for a while, would definitely be like running out of water at Costco or toilet paper or whatever. Believe me, the demand for money is basically infinite. I mean, most people aren't greedy, but most people know in today's paradigm that wherever you are in the world, unless you basically, live in a tribe or, you're a hermit somewhere, I mean, you need money of some type. And so there's a demand every day to eat. There's a demand to have shelter. So this is an infinite demand. So if people lose faith in money, what we consider money, currency, as Mike Maloney continues to remind us, and that currency crisis takes hold of people's consciousness because of a brokerage failure, a bank failure, a virus, a mine shortage, or whatever. That run, once that psychology changes, it can have huge implications literally overnight. And I know people find that very hard to believe because you've just been grinding for so long. And people like me that make a living by forecasting, the monetary metals and what happens in the resource sector and the commodity sector and what happens in monetary history and everything that plays into what you have to think about when you study the gold and silver markets, many have given up on the whole premise that anything will ever happen. I mean, the normalcy bias is so strong that people just say, I've heard that guy 10 years ago said the same damn thing. Nothing's happened. They're full of it. Give up on it, And I'm not doing it because I'm stubborn. I'm doing it because it's a fact. Yeah, it's just the hardest thing to pin down is when. And everybody wants to know that.
Yeah.
But when it doesn't even have to really happen. If I'm making any sense, I want you to listen to me. Let's say, for an example, this corona thing is a big ruse. Let's say it's total propaganda. Okay, I'm doing that as a premise or as a thought experiment to make this point. Even if it's totally propaganda, everybody's acting as if it's so real that you're going to have to quarantine yourself very soon. Same thing in the financial markets. Even if they weren't in a situation that demanded you run to gold, the perception is that this currency isn't going to be any good the day after tomorrow. Everyone's going to run to gold. So I'm trying to make it instilled in people that we don't know what's ahead. That's the worst case. Will it happen in my lifetime? I think it will, but I can't guarantee that. So the course of action to take is a moderate one. Have enough physical metal that you're comfortable. It's that simple. If it never happens, you haven't bet the farm. if it does happen, you have something to fall back on. I think I like to stop there.
I'll give you 3 anecdotes from my own personal life that echo points you've touched on in this interview. One, earlier when we were talking about brokerages, I know I've mentioned this before, but those for whom this may be the first time, back in the 2008 collapse, we had moved a lot of our money after the dot-com collapse in 2001. We had moved a lot of our investments in our 401k out of stocks and into a so-called money market equivalent fund at a major nationwide brokerage, which is still in business, by the way. But we got informed during the 2008 collapse that our account had been no longer accessible. We would not be able to access those funds because it turns out this money market equivalent fund that was paying us a few percent interest on the front side was invested in Lehman Brothers on the back side. When Lehman Brothers went down, we lost access to our funds. So that can happen without warning. Couldn't have seen that one coming. And secondly, just last night at bedtime on the evening news, my wife and I saw on our local news channel that a local instance of a nationwide restaurant chain for which we had bought a sizable gift card because they were giving a promotional special at Christmas time had shuttered their doors because their parent company went out of business and our local branch of it is shut down. So this gift card that we had sunk all these funds into suddenly turned into monopoly money overnight. So we had no warning, no heads up. The manager who saw us every time we came in there using this sizable card didn't have even either they didn't even have heads up or didn't bother to share that with us, probably because of rules that hey guys, you might want to buy a little extra take home tonight because we're not going to be here next week or whatever. So that can just turn on a dime for you. The third thing was you mentioned running out of water at Costco or toilet paper at Costco. We actually made some humorous ads and about does your family get annoyed with you for stockpiling on water. We were at our local Costco not that long ago and saw these the huge storage racks that they have along the back wall of the store stacked 3 high all the way to the ceiling, pallets as far as you could see to the left and right, pallets of cases of water. I thought, wow, they're really getting ready for something. We were in there this weekend. All those are gone. There's a couple random pallets on the floor, and I got some footage of it. And I'll try to splice it in the end of this video so people can see that how quickly things can get cleaned out when there's a perception, as you mentioned, a public mindset perception that there's a need to stockpile, and people just building up even a modest accumulation of either food or foodstuffs or water or dry good paper goods in their home can very quickly deplete what's a very thin just-in-time supply chain, which is going to be a lot worse since we've had quite an interruption in international shipping, that kind of thing. So never hurts to have some extra on hand. You can get a little at a time. Just make sure you've got what you need.
Well, thanks for sharing. I mean, it's the old joke about, and maybe the younger audience hasn't heard it, and it's really not a joke, but a recession is when your neighbor loses his job, but a depression is when you lose your job. It's sort of like that. Well, that's well and good, but it won't happen to me. As I said, I think moderation is the best way to approach it. And I know I'm repeating myself, but people hear this and they do their own research. And the Federal Reserve is a private corporation. It is mostly owned by Europeans. And there is a new world order out there. And there is a trilateral commission and a Council on Foreign Relations and a Davos group and the Bilderbergs. And, they start getting down the rabbit hole and all of a sudden like, wow. And they get very motivated because we do have our self-interest at heart. We're built that way. We're built with the survival mechanism. As it should be. And we're built with a financial survival mechanism. And the financial survival mechanism hasn't been tested in a really, really long time. But when, again, that consciousness flips over from the dollar's good to I don't trust the dollar, if that happens, and I would say when that happens, things will change. And it could happen for us. I mean, we could be in a situation because of this virus thing. As an example, I don't know, where the government says, you know what, no more cash. Cash bad. Cash carries virus. Can't touch cash. We're going to the Fed note. The Fed note's on your phone. Your bank account has been, changed to a blockchain currency called the Fed note. And the Fed note will be accessible by your phone. Your bank will be contacting you shortly with your PIN number. Once your PIN number is entered one time, write it down because you will have to come up with your own new PIN number to access your funds from now on. No more cash. Thank you very much. Have a nice day. Well, thank you again. I enjoyed these questions. They are pretty thought-provoking, and I hope answers are sufficient for all of you, and I will be back with you again.
Thank you, David Morgan, founder of themorganreport.com, for joining us here again on Liberty and Finance. Hey, everyone. Since I started this channel over 6 years ago, my mission has not changed. It was then and is now to help as many people as possible to take care of our families and protect ourselves from the undue risks that we're facing from our fiat financial system, the banks, the Fed, and now the tumbling stock markets. If you've decided that now is time for you to take action by obtaining real money, physical precious metals for your family, I can now fulfill my mission in a new way because I've established a relationship with Miles Franklin, one of the oldest and most trusted names in precious metals in the United States. Over 30 years, family-owned, rated A+ by the Better Business Bureau, with 0 customer complaints over their 30 years of service. If you've decided that now is the time to take action and to acquire physical precious metals, just email me at libertyandfinance@gmail.com. I'll get you connected with the right licensed and bonded dedicated agents who can help you acquire the physical precious metals that you need to protect your family's finances. Again, email me at libertyandfinance@gmail.com. I'm confident that together we can take better care of our family's financial futures. Reluctant Preppers provides educational awareness and commentary only. Opinions expressed do not constitute personalized financial advice. Viewers are encouraged to do their own research and seek qualified personal financial consultation before making investment decisions.